Hey everyone, Dave Silliman here with Sakari Lux Opportunity Fund. Today we're going to be talking about opportunity funds, what they are, how they work, the benefits for investors, where investors need to be aware of, and also most importantly at the end of the day, how investors can actually get involved and invest in the few opportunity funds that truly are available out there and what to look for. These things are time sensitive for investors, as investors have a 180-day window to take advantage of this. If they don't, then they lose out on what this opportunity fund and this IRS Opportunity Zone program is all about. So let's kind of talk about what it is, what it's about. We're going to start with that. Basically, the IRS has come out under the recent tax law changes under Trump, and basically they've set up these opportunity zones through each of the state CEOs and the governors, identifying low income, distressed type areas that need or are in community revitalization, as we speak right now. And that's the focus of what these funds are for. These funds are designed to revitalize the communities. And if you kind of think about it, it's brilliant in its approach while at the same time flawed. The brilliance in the approach is that instead of necessarily using taxpayer municipality dollars, meaning dollars that have come into the city that are going back into these communities through grant programs and nonprofits and everything else like that, Trump has said, let's open this up to businesses. Let's open this up to real estate investors and give them an opportunity to establish a qualified opportunity fund, use the fund money and give a tax benefit to the investor on the front side of it. The idea of these funds is that they're not geared towards a short-term investor looking for, a double-digit rate of return. They're not your atypical type of, let's say, funding outlet for businesses. These are for investors that have a capital gains tax liability, and they're looking to defer that tax liability. So let me kind of give you an example. I recently spoke with an investor who was facing just this exact situation. He sold a business and had a $60 million tax liability, capital gains tax, and he's looking to defer that $60 million. Now, these opportunity funds, what I mean by long-term, they're set up with a step-up in basis value starting at year 5 and capping out at year 10 at 100% step up in basis at that point in time, meaning that all of that you had deferred, all of a sudden now you don't pay taxes on at all. In addition, what that fund has increased, or the gains on that fund, are tax-free as well. So you don't pay gains on what the fund itself has done. So that's what IRS Qualified Opportunity Funds are for. They're for reinvestment. Fund managers have to use 90% of these funds have to go back into IRS Qualified Opportunity Zones and IRS Qualified Opportunity Zone projects. And the IRS has got extreme guidance on what those criteria look like. So benefits of investing in them. Investors immediately get to take a tax deferment on capital gains for anything that was sold within the last 180 days. Now that's the downside too. If you think about it, I'm recording this in July. Tax season doesn't start until really January. That's when the spotlight is going to be put onto this and these opportunity zones in a big way. A lot of the investors that are facing capital gains penalties or capital gains taxes when they're getting ready to go and do their taxes in January will have missed out because let's say they sold something in February. They had until August to claim that deferment. They don't find out about it until January when they go to their tax planner, and their tax planner says, oh yeah, by the way, this exists. Well, great. But it doesn't do that investor any bit of good. They're still going to be responsible for those capital gains taxes. So That's the benefits of investing in them. The investor beware of that 180-day window. If you have sold something, whether it's cryptocurrency, whether it's real estate, whatever it might be, if you have sold something in the last 180 days that you are responsible for a capital gains tax on, and the minimum gains tax qualifying criteria is $50,000. So if you have sold something and you've got a $50,000 gains tax, you can invest that $50,000 if it was done within the last 180 days. You have a 180-day window. Now, what should an investor expect when investing in these funds? They should expect that the fund manager, upon investing, the investor should get a statement letting them know it should be something that is documented, dated. They also should get an end-of-the-year statement, no different than you would if you invested in a Vanguard fund. You should also get quarterly statements. As an investor, you should be able to have some sort of investor portal where you can log into, you can track your investment, see how it's doing, and also the type of projects that your investment is investing into. As an investor, there's a couple different type of ways or what you get from this. One is opportunities stock, qualified opportunities stock. In my opinion, I think that is right now, given how new this program is, that's going to be the route that investors should be looking for, is for the stock. You're going to be able to, you should see then some sort of offering memorandum laying out a full risk analysis, a full financial analysis on what the company is, the direction, the trajectory, the forecasts, the estimates, etc. Another aspect of this is qualified opportunity partnership and qualified opportunity property, which basically is where you're getting a percentage of the equity in the property. Now, the guidance on those is not as clear as what the guidance is on opportunity stock. Opportunity stock also for investor protection falls under SEC guidance, Reg D, which is something that any company that truly sets up a registered C Corp that is designed in function and purpose around these opportunity qualified opportunity funds and qualified opportunity investments. You should be able to take a look at the charters. You should be able to do, as an investor, your due diligence. It becomes a lot harder to do that type of due diligence as an investor when you're looking at a partnership stake interest in something or an equity stake, especially when the guidance on that is very unclear right now at the moment. The other thing that the investor needs to understand is that this is a self-certification process right now for businesses, meaning that at the end of the year, the business is going to have to send and fill out self-certification forms with the IRS and get registered with the Department of Treasury as a qualified opportunity fund. The guidance on, again, going back to just investor safety and investor security, the guidance on the equity stake or the property position and the guidance on the partnership position is very unclear right now at the moment. There's a lot of opportunity for investors to potentially put their money into one of these other two types of outlets, and the person or the company that set them up takes the money and run. As much as I hate to say it, I think we're going to see that. We saw that with home loan modifications under Obama when that first program came out. A few bad apples really kind of ruined the whole basket for the people that were really, or the companies that were really trying to do it right and truly help the homeowners prevent foreclosures. So now, how to invest? Where do you find these investments? If you go to your financial planner, you go to your CPA, your tax advisor, your tax judge, whatever it might be, there's no doubt that that these exist, that this opportunity is there. The question is, where do they send you to? So let's kind of talk about, right now there's only literally less than a handful of these opportunity funds that are set up and established. One of the big ones that I'm looking at, that I'm talking about right now in this, is the Sakari Lux, SIKARILUXE. It is a C corporation. All of the investor due diligence is available to review. They've already have got their first project. They're already on their way to being funded. It's an active fund that is open and available for investment right now. So if you sold something back in February, let's say crypto, and you're looking at $100, $200, $300, $1 million tax penalty, you've got that 180-day window. I would recommend and am recommending the Sakari Lux Opportunity Fund. They're focused in Tampa. 100% of their core focus is the redevelopment of areas within Ybor City in Tampa. Again, from an investor standpoint, I love it because all due diligence, all financial statements, the business plan, the hotel summaries, every single solitary thing, the charters, everything about the business that an investor could want to know to feel like, hey, even though that this is a long-term hold investment for a 10-year period, everything is there for that investor to feel comfortable and to know that this is an investment that not only do they get the tax benefit today, depending on tomorrow, they know that they're going to have a rate of return from a proven model, plan, process, and system. Everything in business, people, process, products. They've got the product is the Opportunity Fund. It's an IRS. It's a federal program. There's $6.1 trillion, according to the New York Law Journal, that was in unrealized gains that could be going into these funds. Do I think that all $6.1 trillion is going to get invested? No, not a chance. I think maybe 7, 10, 15% of it will, but you're still then at that point talking hundreds of billions of dollars. So this is a huge opportunity right now. This is the time, though. Knowledge is power. The time is now to understand, to learn, to invest. Signing off. Check this out. Sakari Lux Opportunity Fund. If you're an Opportunity Fund investor, if you're facing capital gains, Sakari Lux Opportunity Fund.